Everybody, this is Kevin with Leading Edge Financial Planning. We have a lot of new clients that come on and work with us, and so this series is all about trying to overcome your pain or your fear, just the way that investing in markets can make one feel. Now, for people that we work with, a lot of the people we work with are high income, and therefore you start to build a lot of wealth, and it can get very anxiety producing, especially as you get closer to retirement, knowing that retirement is coming. So really the focus of this series is to educate and try to help put these investment markets, which seem to be getting crazier every year, in perspective. Last time we did a video on defining your investment philosophy and finding out, who should you trust with your investment philosophy. So please see that video. If you don't have an investment philosophy, if you don't have a basic understanding of how markets work and return probabilities, that's a good idea to get an investment philosophy. Today, we're going to talk about fear losing all your money. And this is one of those ones when we ask clients, markets are down 20, 30%. And we say, okay, we appreciate you talking with us about your investments, and markets are down and they seem like they're going down, although they've been down and we don't know what's going to happen, but it sure feels like they're going to continue down. We say, what's your fear right now? And they say, the fear is it's just going to keep going down. So the fear is losing all my money. Duh, that's the fear. And it's a fear that, human beings should have. I mean, the fear of losing something is a very painful experience. So how do we mitigate this fear? What can we do with our investment portfolios? Well, this is a chart that's in standard textbooks for investments. And please just hang with me for a second here as we get through this part that's a little bit more tricky. But we're looking at two different risks that we all have when we invest. The first risk is this systematic risk. This is the risk that you have, the amount of risk that you have just by investing in the world, all investments, okay? All investments, there's a certain amount of market risk, and you can't diversify this risk away, okay? When you own the whole market and the market goes down, the whole market goes down 10%, you're going to go down 10%. That is just the way it works. What we believe is not to have this unsystematic risk, which is non-market risk. So this could be something like owning one company. Yeah, I love Apple. I love all my devices. I love Apple. But if you only owned Apple and something happens with the CEO, some chips get banned, whatever happens with Apple, that's one company risk. And so not only do you have the market risk, if the market goes down 40%, Apple will probably go down. You have that market risk. You also have all that extra risk with owning one company. What if the dollar drops as the currency in the world? Well, you own an American company. What if? So really what they've looked at over the years is by having about 20 companies, you start to reduce the unsystematic risk, or the risk of having some event that happens to your investments as opposed to the market. I really think it's prudent, if you're thinking about losing all your money and you're concerned about that, is really go farther than that 20 and just own the market, because then you are only dealing with this one risk, which is the systematic risk or the market risk. So is the market risk something still to be afraid of? In our portfolios, we believe in investing in markets and tilting towards some of the, what we believe will be higher expected returns. No guarantee, but the market risk is still real. By owning public markets, it mitigates total catastrophic loss. Have you heard of the story of someone that made a ton of money and then all of a sudden you've heard, they lost it all? Probably was not owning the market. Now, it could have been owning the German market after World War II or something like that. But again, we're going to talk about mitigating that. Can a market lose 50% and stay low for the rest of your life? Now, it probably depends on how long you live, right? If you live a long period of time, I'd say it's pretty unlikely. But it is possible. It is possible. Can it lose 100% and wipe you out? If you own the world markets in investing in equities, and 100% of your investment is wiped out, what's had to have happened is major war, famine. It's just, there's going to be things that are just terrible no matter what you own. And, but that's really why owning the market, at least you're mitigating your risk. So the fear of losing all your money, take smart risks with probabilities of good outcomes. That's what we believe in. So this is the world. Okay, this is all of the world dollars that flow into public equities. You can see that 59% of all money, I shouldn't say dollars, all money flows into U.S. companies. And Apple and Amazon are bigger than most of these countries that are in the rest of the world as far as the amount of money invested in them. But by owning at least other marketplaces, you are diversifying against some of the United States risk. So, and I'll show you an example of that with Japan. Okay, now when I finished college in 1988, I graduated. I went out in 1989. All my professors at the university all loved Japanese companies. You might not remember it now, but Japanese companies were taking over the world. Japan was buying Rockefeller Center. All this stuff was happening. This was the Nikkei stock market. And in 1989, it hit its peak, maybe 1990. I think it's 89, the end of 89. But then you can see this cut in half, 50% immediately. And then from 89 to 99, if you invested all your money then, you were still down by more than 50%. And then after 2000, after 2009, so you go from, losing about 70% of your money investing in one country. Now, is the U.S. Japan? We can all argue no. U.S., we think U.S. is better. But the Japanese investor at that point, most of my professors, finance professors, thought Japanese companies were continue to go up. They probably all lost a bunch of money. But what we see happen is it took a lot of years, more than 30 years, for the market to even come back. I think it's reached back to what it was at that point, but it could be a little lower or higher depending on the date of this recording. So now, let's say, for example, that you are an investor and you are 25 years of age in 1989, and you just started dollar cost averaging, putting your money in every month. You had a 401k, putting your money in. This blue line here, and this is from a frugaldoctor.com, really excellent study about Japan. If you're interested in this, I would go to that site and check out all his graphs and data. Instead of, just investing all your money at once and, waiting years for it to come back, you just dollar cost average your money. And the blue is the dollar cost averaging. After 30 years, you invested $300,000 and your portfolio value would have been 606. So this is the power of continuous investing. This is the power if you're working for a company or you're doing something else and you have 10, 15, 20 years from retirement, is just keep investing. I think, that does mitigate some risk because market prices, when they fall, you would hope that you're going to get higher expected returns in the future. So the final argument for investing worldwide is that this 10-year period from 2000 to 2009, the end of 9, was the lost decade in U.S. stock market. S&P 500 was down for 10 straight years. If you invested at the beginning of the millennia, the end of the millennia, you had less money, 10 whole years. This is what's happened since then. So we can see that the U.S. market has been on a tear for 14.2 years. Right now, foreign markets the last year and 9 months have been up greater than the U.S., but, this is what thinking about risk first, the fear of losing all your money. If you diversify your money, you have a much less great risk of losing your money. So what are some of the other things that you can do? So what not to do? So buying individual stocks. Buying individual stocks is dangerous. Even if you buy 10 or 20, Again, the last couple years, seven stocks really drove a lot of the S&P 500. If you don't own those seven stocks, you're in trouble. So buying individual stocks is a risky business. Just invest in one country. Yeah, you might not get higher returns by investing worldwide, but you are more diversified, and you might get higher returns. But just investing in one country, if things go bad for that country, again, that is a fear of losing all your money. Thinking about monthly or yearly returns. Okay, so this is the greatest enemy of long-term investing, is the short term. Because when you look at charts of long term, you say, okay, that looks pretty good. But then when you go down into those days, if any bad decisions are made, there's a tremendous risk that you will mess up your long-term returns. So checking your accounts 5 times a day, not so good. If you want to be a happier investor, is put your plan together and then check it once a year. You can check your account just to make sure the dollars are still there, but don't worry so much about the performance. And then the final one is absolutely the hardest one. And that's thinking that you or someone else knows when the big one is coming. And the big one means the big crash. Okay, I've been doing this for a while. Every year, probably every month of every year, I've had someone call me and say, Kevin, I think the big crash is coming. And even if you're right with calling the big crash, even if you called COVID and you got out, did you get back in? And there's a whole nother stress that goes on when you get in and out. So no one knows when the big one is coming. People do claim they know, and they do get lucky sometimes, but the world, the Middle East, the Far East, South America, the United States, war, drought, all these different things are going on all the time. What will cause the market to go down by 40 or 50 or 60%? We don't know. We don't know. That's the truth of the matter. In 2008 and 2009, although some people called it, it was really hard to have gotten out and then gotten back in. So if you want to be a happy investor, diversify and think long term. Thanks so much.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.